Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Market Recap, June 15. This video presents a direct informational narration of the source document. All right, let's dive right in. The immediate focus today, Monday, June 15th, is the major agreement to fully reopen the Strait of Hormuz this Friday. It's been closed for several months now, so this is significant. The electronic version of the Memorandum of Understanding has actually already been signed. The formal signing ceremony? That's officially on the calendar for this Friday, June 19th, over in Switzerland. So what does this all mean for the markets? Well, this reopening is acting as a massive catalyst for risk assets. We're seeing oil prices tumble, while Bitcoin, gold, and U.S. equities are all surging. But there is a catch here, an underlying divergence regarding transit fees. On one side, there's the argument that the strait should permanently remain free under international maritime law. Iran's provision, however, explicitly states they will only allow free passage for a 60-day window, with plans to start collecting fees after that. Still, even with that conditional timeline, those 60 days give the market a solid runway to rapidly reprice risk assets. Now, looking at broad market performance, U.S. equities experienced a really comprehensive breakout today. The Nasdaq absolutely led the charge, surging over 3% as capital aggressively rotated back into the technology and AI sectors. We also saw the S&P 500 rise 1.65% and the Dow advance 0.92%, with the vast majority of sectors moving higher. The main exception here, the oil and gas sector. Traditional energy giants involved in exploration and extraction faced collective profit-taking. As those geopolitical premiums evaporated, WTI crude fell 4%, dropping right below that key $80 threshold. While fears of supply disruptions are swiftly fading in the rearview mirror, we shouldn't rule out the possibility of a future technical rebound driven by inventory restocking. From a technical standpoint, the setup is really interesting. The S&P 500 actually gapped up right at the open, generating a highly bullish signal as it cleanly broke above the dual resistance of both its monthly and 10-day moving averages. So, two major downward pressures have basically just been lifted: the recent geopolitical risks in the Middle East and a heavy load of short positions established during the prior market decline. According to recent data from Goldman Sachs Prime Brokerage, traders had piled up significant short volume over the last 2 weeks. With the transit agreement finalized, those positions had to be rapidly unwound. Consequently, today's upward drive wasn't just fueled by fresh capital, it was amplified by a massive short squeeze resulting from large-scale hedge unwinding. As the index regains momentum for an upward breakout, the primary technical observation point now shifts to the resistance zone right near 7,600 points. At this juncture, there's a pretty stark contrast in how institutions are positioning themselves. Take JP Morgan's trading desk, for example. They had recently been tactically cautious, but just issued a new report reverting back to tactical bullishness. Their core thesis argues that the geopolitical thaw and the strait's reopening will directly push global institutional capital into a fierce risk-on cycle, forecasting a high probability of breaking through that 7,600 level. But on the flip side, this directly contradicts Goldman Sachs, which maintains a structurally cautious view and continues to warn investors that this momentum might actually fade. Shifting gears to central bank catalyst, the market is staring down a sequence of major events, starting with a Bank of Japan rate hike scheduled for Tuesday. Historically speaking, market declines tied to rate hikes usually happen before the actual event rather than on the day of, which indicates this news is largely priced in. Even if the BOJ sends a relatively hawkish signal, it's unlikely to cause major disruptions as long as it stays within expected bounds. The real wild card? Wednesday's Federal Reserve meeting. This is the primary source of market uncertainty right now. It's the very first meeting under a new chairman, and unlike the Powell era, Wall Street just isn't familiar with this new leader's policy style, communication approach, or inflation tolerance. So any defensive adjustments we see on Tuesday will likely be driven more by traders trying to evade Wednesday's Fed uncertainty than the BOJ decision itself. Amidst all the broader market heat, small-cap stocks noticeably lagged behind today, with the Russell 2000 closing up only 0.82%. This underperformance is largely tied to the 10-year Treasury yield, which is just hovering right near that 4.5% level. The bond market remains highly cautious ahead of the upcoming Fed meeting. And because financial stocks make up such a heavy weighting in the Russell 2000, all this intense yield curve positioning ahead of the BOJ and Fed decisions has forced regional bank stocks into a defensive wait-and-see posture. That dynamic heavily marginalized rate-sensitive small caps during today's broad equity advance. Let's talk about the space economy sector, because the leading entity, SpaceX, just saw its share price extend an incredible run. It surged another 19.6% today to reach $192.05 per share, cementing a massive $2.52 trillion market capitalization. Capital continues to just flood into this asset, transitioning the market narrative away from early sentiment-driven speculation toward much deeper analyses of valuation and profitability. That being said, highly speculative capital inflows are fully expected to persist during the 15-day window prior to the company's official inclusion in the Nasdaq 100 index. Furthermore, options trading for the stock is scheduled to launch tomorrow, which is likely going to introduce some additional volatility parameters into the mix. We're also tracking some distinct shifts occurring in secondary sectors. Within the broader space segment, capital allocation is definitely becoming more rational. Companies lacking core competitiveness remain weak, while enterprises with actual delivery capabilities and commercial orders are regaining traction. Rocket Lab is a primary example of this, staging a solid 6.7% rebound after establishing a base near the $100 level. Simultaneously, airline equities moved higher today, with American Airlines closing up 1.22%. That sharp drop in oil prices stemming from the geopolitical agreement directly translates into tangible margin relief, significantly mitigating fuel cost pressures as these airlines enter the peak summer travel season. Moving over to chips, the semiconductor sector experienced another major breakout, actually driving the semiconductor index to a brand new record high. The optimism around the AI hardware supply chain continues to escalate. Micron Technology surged 10.8% today, fueled by some massive price target upgrades from multiple institutions. TD Cowen aggressively raised its target for Micron from $660 all the way to $1,500, while RMEC elevated its target from $525 to $1,200. The core logic driving these massive revisions? There was growing market conviction that the demand cycle for high-bandwidth memory and AI server infrastructure will persist significantly longer and be much stronger than anyone previously anticipated. Then there's NVIDIA. The company just filed with the SEC for a 7-tranche bond issuance, with maturities spanning from 2 to 30 years. What's fascinating here is that they only plan to raise $25 billion, but the offering attracted a massive $85 billion in investor demand. That level of oversubscription underscores incredibly high institutional confidence in their fundamentals. Now, unlike other tech giants that issue debt just to offset heavy data center capital expenditures, NVIDIA operates with an exceptional cash surplus. They're projecting operating cash flow to exceed $200 billion next year. So this $25 billion issuance really functions as a capital structure optimization tool. It allows the company to lock in long-term funds at relatively low costs to secure capital for future ecosystem investments, strategic partner expansion, and potential acquisitions, all without impacting its credit rating. When we contrast the technical profiles of these key semiconductor players, we're seeing some diverging paths. AMD continues its strong upward momentum, advancing another 7% today to reach new historical highs. This was supported by Citi, who upgraded AMD's price target from $460 to $575, reflecting the gradual scaling of its new generation AI GPU products. Conversely, NVIDIA opened with a gap up and approached its monthly moving average, but it continues to face technical hesitation. It absolutely must decisively breach the dual resistance of the monthly moving average and the $215 level to strengthen its short-term trend. Failure to break this zone could trigger a secondary pullback, as the stock has remained technically restricted near the $200 level for an extended period now, despite analyst targets ranging from $300 to $400. Over in the media sector, we had some major M&A news. Fox announced the acquisition of streaming platform Roku for $160 per share in a mixed cash and stock transaction, which is expected to close in the third quarter of next year. Post-transaction, existing Fox shareholders will retain approximately 73% of the combined entity, while Roku shareholders will hold about 27%. Following the announcement, Fox's stock fell over 15%, really reflecting investor concerns regarding them taking on $12 billion in new financing debt. Meanwhile, Roku's stock closed at $140, maintaining a structural $20 discount and an active arbitrage spread relative to that $160 buyout price. Finally, the cryptocurrency sector registered some continuous rebound momentum today, with Bitcoin successfully reclaiming levels above $66,000. This upward pressure was partly catalyzed by reports that MicroStrategy has resumed purchasing Bitcoin. Functioning as a sector bellwether, Coinbase surged over 6%, creating a distinct technical gap up at the open. The absolute crucial metric moving forward is whether Coinbase can defend this newly formed technical gap through the incoming volatility. Specifically, its ability to hold this level through Tuesday's trading and navigate the uncertainty of Wednesday's Federal Reserve interest rate decision will serve as a critical indicator for determining whether this crypto sector rally is just a brief technical bounce or the start of a medium-term trend reversal.